Welcome to the Wealth Studying Podcast. This is episode 490. Today is August 24th, 2025. I'm your host, John Pugliano. I'm also the founder money manager at investablewealth.com. Well, the stock market surged on Friday, and it was all because of an assumption that the Federal Reserve is certainly dovish, or maybe that they've capitulated and they are definitely going to lower interest rates in the future. I want to go through a real quick lightning round today and give you some reasons why. Well, number one, I don't care whether the Fed raises or lowers rates anyways. I'm cynically optimistic. I've been cynically optimistic about this market for a long time, and I own what I believe are companies that have a good, long, solid growth projection regardless of whether the Fed lowers or raises interest rates. I think a lot of what you're seeing in the market today, even though generally the S&P 500's up, but hey, the S&P 500 has been putting in record highs consistently. What you're seeing really rising is a lot of the junk stocks that are in the small caps. Now, I'll have more to say about that in a minute, but again, bottom line, I'm not being negative here. I'm totally cynically optimistic. I remain invested at least 80% in the market, and that cash I have on hand, I'm going to use to continue to buy into these good long-term stocks, again, regardless of whether the Fed raises or lowers interest rates. But let me throw a bit of a wet blanket over all this enthusiasm about the Fed lowering rates. Well, first off, just because the Fed says they will, or better said, just because Wall Street suddenly interprets the Fed as going to lower interest rates, that doesn't mean, in fact, it'll happen. You don't have to go back any farther than the fourth quarter of 2023. And you'll remember that the Fed then supposedly took a dovish stance, and Wall Street went crazy with a lot of people projecting 6 rate cuts coming in 2024. Well, again, if you'll remember, we got almost a full year into from when the Fed supposedly went dovish, because we didn't get the first rate cut until October of 2024. And the Fed ended up cutting twice, but in a way you could argue it was 3 times because one of them was a 50 basis point cut. But again, it was a good 10, almost 12 months later that they actually end up cutting. They didn't cut anywhere near to what the Wall Street enthusiasts were thinking they were going to cut. And even more importantly than that, and this is kind of the next point, just because the Fed lowers their Fed funds rate doesn't mean it'll have any impact on long-term rates. And that's exactly what we saw happen last October, September, when the Fed did cut their Fed funds rate. The 10-year rate actually went up. Now, beyond the fact that the Fed may not cut at all, or if they do, it may not be much, or even if they cut, it really may not impact longer-term interest rates, which is what the market ultimately really cares about. Another thing to consider is, do we need rate cuts at all? This world that we live in for the last 25 years or so has been diluted into the fact that the economy needs lower interest rates. And I would argue that since 2022, when interest rates did jump up significantly, and everybody remember they were losing sleep over the inverted yield curve, and that meant 1,000% of the time when the yield curve inverted, the economy went into a recession. Well, look at the stock market. It's continued to go up since 2022. And while the Wall Street isn't Main Street, I would still argue that there's a great deal of strength in this overall economy. The fact that we're weathering through this crazy volatility with tariffs, and yet the market and the economy pretty much are not missing a beat, that's, if nothing else, evidence of the fact of how strong and resilient the overall economy is. And again, I would argue, as I have for many years, that we don't necessarily need lower rates, not extremely lower. I don't think we're going to see the 10-year get much below 4%, unless we do go into some kind of a recession. And that's because money should have a cost to it, right? There's a time value to money. And if you're borrowing money over time, then logic tells you you should have to pay a certain level of interest rate for that. But we've got deluded into thinking that money is free to borrow for 2 primary reasons. Well, sort of 3. The sort of 3 one is that the Federal Reserve, and one of the reasons they're trying to keep things stable now on interest rates is because they totally ruined the mortgage economy for the next generation with the wobbly knee policies that they had during the pandemic. Right now, the majority of mortgages in place have interest rates below 4%. And so a lot of people think that, well, you should be paying 4% for a 30-year mortgage. Well, that's not the case. Again, unless there's some catastrophic recession on the horizon, I don't think we're going to see interest rates get anywhere near 4% for a 30-year mortgage. And it's just because of the time value of money. They should have never gotten down into the lows were, 2.5%, 2.75%, 3% mortgages during the pandemic. Those are absurdly low levels. And the reason I say that the Fed, because of that, has ruined the mortgage industry for the next 30 years is because no one is leaving their homes. People that have that below 4% mortgage can't afford to sell their house and go get a 6 or 7 or a 5.8% mortgage. The differential's too high, so they're locked in those current homes and mortgages. And the other point with mortgages that were issued during that time period, most of those are not assumable. And so it not only locks in current homeowners because they can't afford to step up to a more expensive home, but it also locks out prospective home buyers that can't come in and assume those lower rates. And that's why you're seeing a stagnant real estate market right now, which again isn't going to change anytime soon because even if the Fed lowers rates, they're not getting anywhere near 4% on a 30-year mortgage. So that problem's not going to be fixed. The other 1 and 2 reason that I don't think rates are going lower anytime soon or ever at this point is because of the delusion that we've had, not just over the pandemic, but really since about 2000. And starting right around 2000, 2001, that's when China entered the World Trade Organization, and over these last 25 years, they have massively flooded the global market with manufactured goods and products that were not only below the prevailing rate, but because these companies, for the most part, are not profitable and many owned by state-owned organizations that never have to be profitable, this China manufacturing surge effectively exported deflation to the entire world and specifically to the United States. And so for a good bit of the last 25 years, or at least the 20 years prior to the pandemic, we saw little to no inflation in terms of the Fed's expected 2% inflation rate. If you remember, there was a good, probably close to 15-year period when they kept saying that they wanted to stimulate the economy because we couldn't get over 2% inflation rate. That was because primarily of this surge in goods coming out of China. Well, you've probably noticed that since the pandemic, and especially since what I would call the beginning of the Cold War II, and the industrial policy and the tariffs and the other national defense security type measures you see coming into increasing more onshoring or reshoring or nearshoring of manufacturing either within the United States or North America, or at least to more friendly forms of governments, that while globalization isn't over, certainly we have reached peak globalization and prices are going to go up because they should have never been as low as they were over those previous 20 years. And that means that if inflation is going to run higher than 2%, the interest rates can't go anywhere near to where they were over these previous couple decades. And specifically, and this is the biggest reason of all why we've been deluded about low interest rates, is that the Federal Reserve purposely kept interest rates too low for too long, and I'm talking for in excess of a 15-year period following the Great Financial Crisis or the housing bubble that started in 2007, 2008. When you look at housing prices right now, it's hard to believe that if you just go back, a few years prior to the pandemic, around maybe 2016 was the year that the effects of the collapse of the housing bubble in 2008, those effects were really just getting resolved around 2016. Because prior to 2016, you still had a historic amount of houses that were underwater in terms of being, less than what the mortgage rate on it was. And that's because housing prices had gotten so overinflated, prior to 2008, that it took another close to 8 years for inflation and a lot of the Federal Reserve buying up mortgage-backed securities to get a balance to where a small acceptable number of houses were underwater. Now, of course, since the pandemic, the hysteria has flung the other way, and again, with the Federal Reserve artificially pulling down interest rates as low as they did, that sent housing prices skyrocketing, and that's great for all those mortgage-backed securities that are on the Federal Reserve and, throughout the banking systems, but it's bad news for anybody that's trying to buy a house. And that inflation isn't going to go away anytime soon because we're simply not building enough houses. So housing prices, I don't see going down anytime soon either, again, unless we hit a really critical recession. And for all those reasons, and I'll throw in one more, that are going to keep interest rates higher than what we've seen over the last 20 years, other than through this post-pandemic, hyperinflation that we've had. But the other final reason that's potentially going to keep interest rates at least stable or higher than people want is because of the overall employment rate. Every day you have baby boomers exiting their jobs and moving into retirement. And that trend is only accelerating. And because the baby boomers are so large in number, that exit from the workforce creates a shortage of employment and therefore holds the unemployment rate lower than what it might otherwise be. And with the Federal Reserve's supposed dual mandate of trying to maximize employment, again, unless there's a severe recession, I don't see the unemployment numbers spiking up high enough, over these coming months to force the Fed to drastically cut interest rates. Okay, now, all those reasons, I'm not saying that the Fed's not going to cut 25 basis points in September or whatever. They likely will. They probably are capitulating to the orange man. But I don't expect it to have a major impact on the overall economy or specifically the stock market outside of the big uptrend you've seen in small cap stocks. And we'll talk about this in future episodes, but I would be cautious there. Keep in mind, a lot of small cap stocks are cheap for a reason. Something in the range of 40% of them are not profitable. And it doesn't matter how low you lower interest rates, unprofitable companies generally remain unprofitable. These are speculative, one-story type companies, and I think generally that category should be avoided. Not small cap stocks in general. I do like the S&P Small Cap 600 Index, which filters out for profitability. Yeah, again, more about that in future episodes. But until then, as always, this is John Pugliano wishing you the very best returns.